Welcome, and thank you for joining us for another deep dive. We're exploring that really fascinating place where our psychology, intersects with our money. I'm so glad you're here with us. Have you ever found yourself looking back at a financial decision? Maybe it was a stock you bought, or, oh, maybe one you held on to for just way too long, or even just a spending choice and you thought, what on earth was I thinking?
Oh, absolutely. That feeling is universal.
Or that really frustrating realization, like, why did I do that when I knew better? If that sounds familiar, trust me, you are definitely not alone. It's a truly universal experience, isn't it? This constant wrestling match with our own minds when it comes to money. And, often we discover that our biggest financial challenge isn't some external market force or a looming recession, but actually it's ourselves.
That's precisely where we're focusing our deep dive today.
Yeah.
It's our mission, really, is to explore building a behaviorally proof portfolio. 4 strategies to protect you from your self-cognitive bias finance. It might sound like a bit of a mouthful, I know, but it's incredibly important. And quite frankly, it can be liberating once you get a handle on it. We're going to dive deep into why genuine financial success isn't just about the numbers on a spreadsheet, or the latest investment tool.
Right.
It's fundamentally about understanding and actively managing our own psychology. Our emotions, which invariably bubble up, and the unique life experiences and values that shape our individual attitudes toward wealth. Ultimately, it's about aligning our sort of natural human behaviors with our carefully considered financial goals.
And we're here to try and give you a shortcut, maybe, a fast track to being incredibly well-informed on this topic. We'll help you understand the why behind those puzzling money moves you or, others might make, perhaps even revealing some of your own hidden patterns along the way. Think of it as equipping you with the kind of mental armor, yeah?
I like that analogy.
A set of practical strategies designed to help you outsmart your own brain. And these aren't just theoretical concepts. These are real tools to make choices that truly serve your long-term well-being, rather than just satisfying those powerful, immediate desires.
Right.
Because that struggle between instant gratification and future financial security, it's profoundly real. It's a constant companion for most of us. So we've all made those financial decisions where we look back and just wonder, what was I thinking? Often it seems like it's not a lack of intelligence, but maybe something deeper going on in our minds. What exactly are these cognitive biases we often hear about, and why are they such a powerful, almost invisible force in our financial lives?
That's a great question. It really gets right to the heart of what makes us, human investors, rather than perfectly rational, like robots. Traditional finance, for the most part, has historically focused on tools for optimizing returns and minimizing risk. Think quantitative models, asset allocation theories, all very logical, very mathematical. But then there's behavioral finance, the field we're exploring today. It takes a different approach. It's the study of how our emotions and these cognitive biases, which are basically systematic, predictable errors in thinking, actually affect our financial decisions.
So predictable errors, not just random mistakes.
Exactly. Systematic. And these biases don't just influence individuals, they can sway corporations, even entire financial markets. It's about how people actually behave with their money, not just how they should behave, according to purely rational models.
And what's really striking is how often these biases seem to just override what we know logically is the rational choice. They push us towards impulsive actions that can completely derail our carefully constructed long-term goals. It's not just a personal quirk either, is it? We see these biases impacting everything from small business owners trying to decide on inventory to massive financial markets experiencing those speculative bubbles, sometimes with truly devastating consequences.
Right.
It's like our brains have these built-in glitches that operate almost on autopilot.
Precisely. And it's really important to emphasize that this isn't about being ill-informed or, poorly trained. The research repeatedly highlights that even highly intelligent, well-educated, and well-trained individuals frequently make poor decisions because of these biases.
Wow.
It really speaks to how deep-seated and pervasive these cognitive errors are. They often operate beneath our conscious awareness.
So it's not really about intelligence then. It's something more fundamental to how our brains are wired. It's a truly humbling thought, actually. This is where insights from people like Morgan Housel, whose work often explores the psychology of money, really hit home. He emphasizes that nobody is crazy for their financial choices.
That's such a key point.
Yeah, we all arrive at our financial decisions with vastly different experiences, backgrounds, values. What seems completely irrational to one person might make perfect sense to another, given their unique mental models and life stories. So understanding these underlying mental models, these biases, is truly key to making better choices for ourselves, and maybe, just maybe, understanding others a bit better too.
Absolutely. So shall we delve into some of the most common and impactful biases that we, as investors, often face?
Let's do it. Where should we start?
Well, let's start with one that I think many of us can probably relate to. Maybe even admit to having fallen prey to at some point. Overconfidence.
Ah, yes. Overconfidence. We all have those moments, right, where we feel we're smarter than the market or that we just know how a particular stock will perform. What's the formal name for that financial blind spot, and how does it actually show up in our investment choices?
That, without a doubt, is overconfidence bias. It's essentially overestimating your own knowledge, your intuition, and critically, your predictive capabilities when it comes to investing. It often manifests as this belief that you possess some kind of superior insight into the market, maybe a secret edge, even when the objective evidence simply doesn't support it.
Right. Gut feeling over data.
Exactly. And this kind of inflated self-belief can lead to some pretty significant missteps and often, well, less than optimal financial outcomes.
And the impact can be quite tangible, can it? The research highlights how this bias can lead directly to excessive trading because you're convinced you can beat the market with frequent moves, and also under diversification because you might believe you know enough about just a few specific investments to put all your eggs in those baskets.
Spot on. And fundamentally, it often results in a general disregard for potential risks because you're just so sure of your own judgment, you feel bulletproof.
Is there any hard data on this?
Oh, definitely. A fascinating and often cited study by Barber and Odine really illustrates this. They examined nearly 38,000 households over 6 years, back in the 90s. What they found was quite revealing. Male investors who are perhaps often culturally socialized to be more confident or assertive in domains like finance, they tend to trade significantly more frequently than female investors.
Okay.
And this was largely attributed to this very overconfidence.
Yeah.
And the result? Significantly lower net returns for the more active traders.
Lower returns just from trading too much.
Yes. To put a number on it, the difference between the highest and lowest turnover groups could be over $5,000 on a $10,000 investment over just 5 years.
Wow, that's huge.
It is. That's a substantial amount of wealth just eroded, simply by trading too much, driven by an overinflated sense of one's own market prowess.
That's a vivid and, frankly, a bit painful example of how costly this bias can be. And it's not just about perceived skill or intelligence, is it? There's also this illusion of control element to it.
Absolutely. People become more overconfident when they feel they have control, even when they demonstrably don't. Think about a simple coin toss. People tend to bet larger amounts if they're allowed to toss the coin themselves, as if their physical involvement can somehow sway the random outcome.
Right, like blowing on dice.
Exactly. In investing, this translates to investors believing stocks they own will perform better than those they don't, despite ownership offering only, well, an illusion of control over a company's actual performance.
That makes sense. And what about this information paradox idea?
Yes. That's another interesting facet. We naturally assume that the more information we gather, the better our decisions will be. And, up to a point, that's true. However, studies, like those predicting college football outcomes, show that receiving more information often increases our confidence at a faster rate than it actually improves our prediction accuracy.
So you feel more certain, but you're not necessarily more right.
Precisely. Your conviction about your forecast might jump dramatically, but your ability to be right might only marginally improve, or maybe not at all. It's almost like buying more and more elaborate compasses, but you're still pointing in the wrong direction.
And the really tricky part, almost insidious, is that this overconfidence can persist even after you've had negative trading outcomes. It doesn't just vanish after one bad bet.
Unfortunately, no.
Yeah.
It can take several painful, poor performances before it truly diminishes. And in today's online trading environments, with instant feedback, gamified interfaces, the sheer ease of transaction, this problem can actually be exacerbated.
Making it easier to trade too much.
Exactly, leading to even more excessive trading and, unfortunately, further reduced investor returns. It's a cycle that's incredibly hard to break out of without a strong dose of self-awareness and intentional strategy.
So the core insight here seems to be that our belief in our own superior insight is often a significant blind spot. It leads us to take on unnecessary risk and erode returns through excessive self-directed action.
That sums it up perfectly. That overconfidence can really blind us. But sometimes it's not our ego, but maybe just a single number that traps our decision-making. What's going on when we find ourselves stuck on a number?
Ah, that sounds like anchoring bias, doesn't it? It's that tendency we have to rely too heavily on an initial piece of information, the anchor, when we're making subsequent judgments or decisions.
Hmm.
And the kicker is, sometimes that initial piece of information can be completely irrelevant to the actual decision at hand, yet it still somehow pulls us in.
Precisely. In the financial world, this can lead investors to fixate on a specific price or value, maybe the historical high price for a stock they once owned, or perhaps the price they initially bought it at.
Yeah, I bought it at $50, so I won't sell below $50.
Exactly. That
Yeah.
kind of thinking. And then they base all their future decisions solely on that anchor. They fail to adjust their perspective adequately based on new current information, which might indicate the true current value is much lower or maybe even higher. This often results in insufficient adjustment and inertia. It prevents them from making necessary changes or recognizing a new reality.
Is there a classic example of this?
Oh, the most famous one is probably Kahneman and Tversky's experiment. They asked people to estimate an uncertain proportion, like the percentage of African nations in the UN. But before they guessed, they spun a wheel of fortune with numbers from 0 to 100.
A random number.
Completely random. And people who landed on a high number gave significantly higher estimates for the UN percentage, while those who landed on a low number gave lower estimates.
Wow, even though they knew the number was random.
Yes. It shows how easily we can be swayed by an arbitrary starting point, even one we know has no real bearing on the question.
And this plays out in the market with professionals, too, not just us regular folks.
Oh, absolutely. Studies have shown that even professional analysts' earning forecasts can be too close to industry medians. They get anchored to that average. This causes them to underestimate earnings for firms with high forecasted EPS and overestimate for those with low forecasted EPS because they're anchored to that industry norm.
So they regress towards the mean, even when the data might suggest otherwise.
Exactly. Discussions with analysts themselves have confirmed their estimations were indeed affected by the prevailing industry norm for forecasted EPS, especially when that norm was stable over time. So this bias isn't just for individual investors trying to decide whether to buy or sell. It affects market participants at all levels, from the amateur to the seasoned professional.
So the core insight with anchoring is that the first number we encounter can subtly, yet powerfully, steer our subsequent judgments, often leading us to cling to outdated or irrelevant information.
Perfectly put.
Okay, our next bias takes us deep into the emotional landscape. Loss aversion and its close cousin, the disposition effect. This is that really visceral gut feeling that makes us say, I just can't take the loss. It's a powerful driver, isn't it?
Indeed, it is one of the most powerful psychological forces in finance. Loss aversion is a very strong preference for avoiding losses over acquiring gains of the same magnitude. Basically, the pain of losing, say, $100 is generally felt far more intensely. Studies suggest about twice as intensely than the pleasure you'd get from gaining an equivalent $100.
Twice as intense. Wow.
Yeah, that emotional asymmetry is profoundly impactful on our decisions.
And it leads directly to what's known as the disposition effect, which is what exactly?
The disposition effect is where investors make these seemingly irrational decisions, like holding on to losing investments for far too long.
Clinging to hope.
Right, clinging to the hope that they'll eventually break even. And conversely, selling winning investments too early, just to lock in that feeling of pride or maybe to avoid the risk of seeing those gains disappear.
It's a classic trap, and one I think many of us, if we're honest, have been caught in.
Oh, absolutely.
Yeah.
Schefrin and Statman's foundational work really highlights this dynamic. They showed how the desire to avoid regret, the pain you'd feel from realizing a loss by selling, and the desire to seek pride. The good feeling from realizing a gain drives this behavior. Imagine you suddenly need cash, okay, and you hold two stocks in your portfolio. Stock A is up a healthy 20%. Stock B is unfortunately down 20%.
Yep.
The disposition effect strongly predicts that you'll be far more likely to sell the winner, stock A, to get that hit of pride, that feeling of success.
Even if stock B is the one you should rationally sell, maybe its prospects are worse.
Exactly. Even if selling the loser, stock B, might be the more financially prudent move, perhaps for tax purposes
Yeah.
or simply because its long-term prospects are poor.
And the tax implications really underscore the sheer irrationality of this emotional pull, don't they?
They really do. Selling a winner triggers capital gains tax, immediately reducing your actual profit. But selling a loser, on the other hand, can actually provide a tax credit. You can often use that loss to offset other gains or even some regular income, reducing your overall tax bill and effectively reducing your overall loss.
So financially selling the loser often makes more sense.
Often, yes.
Yeah.
But emotionally, people frequently forego this wealth-maximizing strategy simply due to loss aversion. They choose to hold on to the bad investment just to avoid the psychological pain of realizing that loss on paper.
It's truly penny-wise and pound-foolish, isn't it? When our emotions hijack our logic, costing us real money for the sake of avoiding a bad feeling.
It really is. And this bias can be so powerful that it makes people jump at seemingly attractive double-or-nothing chances to recoup losses, even when the underlying odds are demonstrably stacked against them. They get desperate to erase the loss. The prospect theory value function, developed by Kahneman and Persky, illustrates this quite elegantly. If you imagine a graph of value versus gains losses, the curve is much steeper for losses than it is for gains. It visually shows that asymmetrical reaction. The pain of a loss looms larger than the pleasure of an equivalent gain.
So that graph basically maps our emotional reaction.
In essence, yes. We also see this reflected in investment holding periods. Research shows stocks held for shorter times tend to be winners. People sell them quickly to lock in gains. While stocks held longer are often the less successful ones, people ride the losers down, hoping for that turnaround. It's entirely consistent with the disposition effect.
So the core insight here is that our primitive brain, wired to avoid immediate pain, often sabotages our long-term financial prosperity. It encourages us to cut our winners short and ride our losers down, prioritizing emotional comfort over financial gain.
Precisely. It's a tough one to overcome.
Next up, bias number 4, herding, or as it's often colloquially known, following the crowd off the cliff. It's that deep-seated human comfort we find in numbers, isn't it?
Absolutely. The herd mentality occurs when people find reassurance and, well, comfort in a concept, an idea, or maybe an investment that's widely adopted or believed by many others. This leads them to follow trends without necessarily doing their own independent research or critical thinking. It's a very powerful aspect of human nature, this desire for social validation, this need to avoid being the odd one out.
And the impact. It can completely overshadow rational decision-making, can't it? It significantly increases the risk of financial losses, especially for those who jump in late to a trend. And it can even fuel those massive, irrational, speculative bubbles we've seen throughout history, only to see them burst spectacularly later on.
A very recent and well-known example that many of our listeners will probably remember vividly is the whole GameStop stock event.
Oh yeah, the meme stocks.
Exactly. Many people invested due to intense fear of missing out. FOMO fueled largely by social media hype, often without conducting proper research into the underlying fundamentals of the company itself. This, unfortunately, led to significant losses for many latecomers who bought at highly inflated prices, just caught up in the frenzy.
And if you look back further, the dot-com bubble of the late 1990s is just a prime textbook example of this kind of irrational exuberance.
A classic case.
Yeah, valuations for internet firms like Yahoo, with a PE ratio of 1,300 or eBay with a PE of 3,300, they were absolutely astronomical. They completely defied traditional valuation metrics.
And this happened not because of some sudden revolutionary shift in fundamental economics, but, as the research suggests, predominantly due to the human psyche at play. People were simply swept up in the narrative, the excitement, the perceived inevitable rise of anything internet-related.
It's amazing how powerful a story can be.
It really is. Even purely cosmetic name changes had a significant irrational effect during that period. Firms that changed their names to include .com saw their stocks jump. Conversely, when the bubble burst, removing .com could sometimes help. Computer Literacy Inc., for instance, became fatbrain.com.
Fatbrain.com.
Seriously.
Seriously. And its stock climbed a remarkable 33% in one day, purely due to the name change. There was no shift in its actual business strategy.
That's incredible. It just vividly shows how superficial drivers, when amplified by herding behavior, can lead to profound market distortions.
It really does. So the core insight for herding is that the human desire for social conformity can easily override individual judgment, leading to collective irrationality and participation in unsustainable financial trends. Safety in numbers isn't always safe.
Not when the numbers are heading toward the cliff, no. Okay, bias number 5 is a kind of 2-for-1 special. Representativeness and familiarity. Or maybe what I see is what I trust. Tell us about these mental shortcuts. Yes, these are both heuristics. Basically, mental shortcuts that our brains use to quickly process information and make decisions, because doing a full, rational analysis every time is often just too time-consuming or complex. Representativeness means we tend to extrapolate past patterns into the future, assuming they'll continue. Like believing a coin that landed on heads 5 times in a row is somehow due for tails, even though each flip is independent.
Okay.
Familiarity, on the other hand, is simpler. We naturally prefer things we know and trust, often just because they're familiar. They feel safer, more predictable. While these shortcuts are efficient in many daily contexts, they can lead to significantly inaccurate conclusions when it comes to investing.
The impact of representativeness seems huge. It famously leads investors to chase winners, right? Buying stocks or mutual funds that have had recent stellar performance, assuming that impressive run will just continue indefinitely.
Exactly. But here's the kicker, and what makes it a bias. Studies actually show quite consistently that loser stocks that have underperformed recently tend to outperform winners over the next 3 years.
Really? Losers beat winners.
Often, yes.
Yeah.
By a significant margin sometimes, maybe as much as 30% cumulatively over 3 years in some studies. This dumb money strategy, as some financial professionals somewhat unkindly call it, of chasing past performance is definitively not optimal for long-term wealth creation. Past performance is not indicative of future results, as they say.
Right, that tiny print is actually important.
It really is. And then there's the equally powerful impact of familiarity or local bias. People naturally prefer to invest in what's familiar to them, what they feel they understand, or have some connection to.
Like owning your own company's stock.
That's a prime example. Employees owning a disproportionately large portion of their own company's stock. Or investors tilting their portfolios heavily toward local firms. For example, research shows Georgians own a huge chunk of Coca-Cola stock, with most of those investors living right there in Atlanta, where Coke is headquartered. It makes intuitive sense, right? They see the brand every day. Maybe they know people who work there.
It feels comfortable.
Exactly. What's more, even professional money managers exhibit this bias. Studies show they often buy firms headquartered closer to their own offices. Maybe they feel they have better access to information, or maybe it's just subconscious familiarity.
That's truly fascinating and quite revealing about our innate tendencies. And this bias can actually distort market prices, can't it? It's not just an individual portfolio issue.
No, it can have market-wide effects. In regions with fewer publicly traded companies, that concentrated local investor demand can artificially drive up the prices of those local firms. For example, studies have estimated that firms in the Deep South, which has fewer local companies available for investment compared to, say, the Northeast, are priced on average about 7.9% higher than comparable firms in the more diverse Middle Atlantic region, just due to local demand.
Wow, and internationally.
Same phenomena. Home bias, the preference for domestic over foreign investments, is correlated with higher domestic market returns, which actually indicates a higher cost of capital for firms in those countries. That concentrated demand makes it more expensive for them to raise money.
And these biases can compound, become a double whammy.
They certainly can. Employees, for instance, often combine familiarity with representativeness. They buy more of their own company's stock after its price has already increased significantly, believing that recent past performance predicts future success.
Chasing the winner they already know.
Precisely. Yet, studies consistently show that firms with high employee ownership don't perform better on average than other comparable firms. It's a powerful illustration of how these interwoven mental shortcuts can lead us astray.
So the core insight for representativeness and familiarity is that our tendency to extrapolate past performance and favor the familiar, while maybe comforting, often leads to suboptimal diversification and chasing trends that are already over.
Well said.
Okay, our 6th bias is mental accounting, and this one feels incredibly relatable. My money has different jobs. It's about how we categorize and mentally bucket our funds, right?
It absolutely is. Mental accounting is when we categorize different sums of money into distinct mental buckets. We treat each investment, each sum of money, or each income stream separately, rather than seeing it all as part of a single, integrated, fungible portfolio.
Fungible meaning?
Meaning a dollar is a dollar is a dollar, regardless of where it came from or what you intend to use it for. But in our minds, we don't treat it that way. We literally assign different jobs to different portions of our wealth. This bucket is for rainy days, this one for fun money, this one for retirement, and so on.
And the effects of this mental categorization are quite detrimental, aren't they, in terms of optimizing our finances?
Yes, they often are. It makes us overlook the crucial interaction between investments. This significantly limits our ability to minimize overall portfolio risk and maximize returns through proper diversification and strategies like tax loss harvesting. It can even exacerbate the disposition effect we talked about earlier. Selling a losing stock isn't just a financial decision. It feels like closing a mental account associated with that specific investment, which triggers that painful feeling of regret more acutely.
Ah, so closing the vacation fund account feels different than just taking money from general savings.
Exactly. This bias also frequently leads to poor asset allocation, often resulting in far too much allocation into an employer's stock, as we touched on with familiarity. Despite the stark lessons learned from major corporate collapses like Enron, where employees lost not just their jobs but also their retirement savings because they were so heavily invested in company stock.
A devastating combination.
Truly. Yet, astonishingly, research indicates over 5 million people still have more than 60% of their 401k balance invested solely in their company's stock. It's a huge concentration risk, driven partly by mental accounting and familiarity. We also commonly see naive diversification because of this, like the 1N rule, often observed in 401k plans.
What's the one rule?
It's where employees simply allocate their contributions evenly across all available funds, regardless of what those funds actually are or whether that constitutes an optimal asset allocation strategy for them.
So if there are 10 fund options, they just put 10% in each.
Pretty much. Even if 6 of those are bond funds and only 4 are equity funds, this might leave them with a much more conservative allocation, say 60% bonds, 40% stocks, than they intended or needed for their age and goals, or vice versa. It's diversification by count, not by strategy.
And our perception of risk gets skewed too.
Yes. Investors tend to think in terms of individual investment risk, often measured by standard deviation, which tells you how much a particular investment's returns fluctuate up and down, volatility. But they often overlook its true contribution to the overall portfolio risk. That's what modern portfolio theory really focuses on, how an asset moves in relation to other assets in the portfolio. This is often measured by beta, which compares a stock's volatility to the market as a whole.
So it's like looking intensely at each individual tree instead of understanding the health and composition of the whole forest.
That's a perfect analogy. The core insight with mental accounting is that categorizing money into separate mental buckets, while seeming intuitive or organized, can lead to suboptimal asset allocation, hinder effective diversification, and prevent us from seeing our wealth as a single integrated whole where all the parts should work together.
It stops us from optimizing the whole picture.
Exactly. And finally, bias number 7, framing. It's all in how you say it. This bias fundamentally underscores just how sensitive we are, not just to the facts, but to the presentation of those facts.
It's so true. Framing is the tendency to be influenced by how information is presented to us, rather than purely by the objective information itself. Whether something is phrased in terms of potential gains or potential losses, or identified as risks versus opportunities, the way the message is packaged can dramatically change our reaction and the choices we ultimately make.
A classic anecdote, maybe the most famous one, to illustrate this is the infectious disease problem from Kahneman and Tversky again. People were asked to choose between 2 programs to combat a hypothetical deadly disease outbreak expected to kill 600 people.
Okay.
Option A saves 200 lives for sure. Option B has a 13 probability that 600 people will be saved and a 23 probability that no people will be saved. Which would you choose?
Saving 200 for sure sounds pretty good compared to the risk. I'd probably take A.
Most people do. Now consider another group given the same scenario, but framed differently. Option C, 400 people will die for sure. Option D has a 13 probability that nobody will die and a 23 probability that 600 people will die.
Oh, wait. Option C, 400 dying. That sounds terrible. Option D gives a chance that no one dies. I think I'd lean towards D there. Take the risk.
And again, most people do, but look closely. Option A, saving 200, and option C, 400 dying, are mathematically identical outcomes out of 600 people. And option B, 13 chance of saving 600. And option D, 13 chance of nobody dying are also identical.
Wow, so the exact same choice, just framed as gains versus losses, completely flip the preference.
Completely. It's a powerful demonstration of framing. We're risk-averse when things are framed in terms of gains. It's a sure gain. But we become risk-seeking when things are framed in terms of losses. We gamble to avoid the sure loss.
And we even see this influence with financial professionals.
Yes. Studies have found that when financial advisors were asked about firms described with negative frames like poor growth prospects or higher leverage, they sometimes projected a negative risk-return relationship in certain contexts, which is the exact opposite of standard financial theory, which posits that higher risk should be compensated by higher potential returns.
So even their expert judgment can be swayed by the negative language.
It appears so. And in the context of 401k plans, again, we often see something called extremeness aversion.
Extremeness aversion.
Yeah. Employees, especially when they're unsure of their appropriate risk level, frequently just gravitate towards the most moderate or middle-of-the-road option from the available investment choices. This demonstrates a clear preference for less extreme alternatives, regardless of what might be objectively optimal for their individual financial situation or age. They pick the middle one simply because it feels safer, less extreme. The way the options are presented, with one clearly in the middle, heavily influences their selection.
That makes sense. And another subtle but incredibly powerful framing example comes with Social Security claiming decisions you mentioned.
Right. Framing the decision as claiming earlier means lower monthly income for life versus claiming later means higher monthly income for life significantly impacts choices. Interestingly, prior to 2008, the Social Security Administration often used a break-even analysis frame. This focused on how long you'd have to live to make up the losses from delaying benefits.
That sounds kind of negative.
It's a very negative frame. It highlights potential losses and forces you to confront your own mortality. These inherently negative frames likely pushed many people to claim earlier than might have been optimal for their long-term financial security, just to avoid the loss of dying before the break-even point.
Wow, language matters so much.
It really does. And consider how mental budgeting and purchases are framed in our minds. Research shows people often prefer to postpone payments for necessities, like a new washer and dryer, but they'll readily prepay for pleasure-generating items like vacations.
Why is that? It seems financially suboptimal to prepay, usually.
It often is, because you might incur interest on the prepayment method or miss out on investment returns. But it happens because the pain of payment can diminish the pleasure of consumption. If you pay for a vacation later, perhaps in installments after you return, you might be constantly thinking about the cost while you're trying to enjoy it, which reduces the enjoyment. Prepaying decouples the pain from the pleasure.
You get the pain over with first.
Exactly. But for a mundane item like a washing machine, the pleasure of using it isn't that high anyway, so postponing the payment feels better.
This highlights how our emotional response to payment timing, heavily influenced by how we frame the experience in our minds, impacts our financial decisions.
So the core insight for framing is that the mere presentation of information, whether emphasizing gains or losses, certainty or risk, can dramatically alter our perception of choices and lead us to treat mathematically identical outcomes in completely different ways.
Precisely. It's all in how you say it. Okay, wow. We've just navigated a real labyrinth of these cognitive biases, seeing how our brains can play so many tricks on us, leading to those decisions where we look back and just scratch our heads. But now that we've decoded these hidden influences, the critical question becomes, how do we fight back? How do we actually build a behaviorally proof portfolio that protects us from, well, ourselves?
This is the crucial pivot, isn't it? It's the point where awareness needs to transform into concrete action. Mastering behavioral finance isn't just about knowing these biases exist. It involves continuous learning, but also deep self-reflection, and maybe most importantly, consistent practical application of strategies. It's about being proactive, implementing concrete strategies, and consciously controlling your financial environment to reduce the insidious influence of these biases.
Controlling the environment. I like that.
Yeah, it's about empowering yourself to make better choices, especially when your gut instincts, your biases, are screaming at you to do the opposite.
So let's dive into these practical strategies. Our first strategy sounds fundamental. Cultivate a long-term, goal-oriented mindset. This sounds deceptively simple, but I suspect it's incredibly powerful, especially in today's world that feels so focused on the short term.
It truly is foundational. The core of this strategy is to define clear, specific long-term financial goals. Really think about what you want your money to do for you, and then always keep those goals firmly in mind, almost like a guiding star or a North Star. This helps you focus resolutely on the big picture and measure genuine progress toward those important goals, rather than getting constantly swayed by every short-term market fluctuation, every scary news headline, or every fleeting investment trend.
And part of setting those goals is figuring out what's enough, right? That idea comes up a lot in behavioral finance.
Yes, that's a critical part, as explored by many, including Morgan Housel. Truly understanding what is enough for you, finding that often elusive balance between relentless accumulation and genuine contentment and well-being. Knowing your destination helps you stay the course.
And this mindset, this focus on the long game, it's an incredibly powerful defense against impulsivity and panic selling, isn't it?
Absolutely. It helps you resist that siren call to time the market, which, as our sources from communities like the Bogleheads consistently highlight, is a common and often futile endeavor, trying to jump in and out.
It rarely works consistently.
Exactly. As one insight puts it simply, time is the best tool for wealth management. Consistently investing over time, often through strategies like dollar cost averaging, investing a fixed amount regularly, and cultivating patience generally pay off far more handsomely than trying to be smart and predict market tops and bottoms. It's often about simply staying invested, sticking to your plan, even through those inevitable stomach-churning downturns.
So when the market is down and all the headlines are screaming doom and gloom, what's the advice?
The most effective advice, and it takes discipline, is to zoom out. Instead of looking at the daily or weekly charts that look like a terrifying roller coaster,
Yeah, those can be scary.
pull up the 5-year, 10-year, or even 20-year charts for the broad market. You'll often find that what felt like a catastrophic drop in the moment, it just looked like a little blip of a downswing that won't even be detectable in the grand scheme of long-term growth.
That's a great perspective shift.
It is. The consensus among experienced, successful long-term investors is crystal clear. Time in the market trumps timing the market.
Yeah.
All the time. It's a powerful antidote to those short-term emotional reactions.
It also seems to require a profound mindset shift. Viewing market crashes not just as unmitigated disasters to be feared,
Right.
but rather as potentially powerful buying opportunities, a chance to acquire assets at a discount.
Precisely. This counterintuitive approach aligns perfectly with long-term wealth building. It completely flips the script on the fear response. It transforms that natural anxiety into a potential strategic advantage if you have the long-term view and the available capital.
And alongside that, flexible planning is crucial, not having rigid expectations.
Absolutely crucial. Avoid rigid plans that assume, perfect 8% market returns every single year or continuous uninterrupted employment until age 65. Life is unpredictable. Instead, cultivate a mindset where you're actually okay, maybe even happy, with a wide range of potential outcomes. And proactively build in robust buffers like an adequately funded emergency fund to not just survive, but maybe even thrive when the unpredictable inevitably happens.
That sounds like Nassim Taleb's idea of anti-fragile.
Exactly. This approach makes your financial life more anti-fragile, meaning you don't just resist volatility and shocks, but you're actually positioned to potentially benefit from them. You grow stronger through adversity, not just survive it.
So the real insight here is that when everyone else is panicking, your long-term vision becomes your superpower. It allows you to see opportunity where others only see disaster, and it fosters true financial resilience.
That's the goal.
Okay, our second strategy moves us decisively into action. Harness the power of automation and discipline. This sounds like where we really try to put our willpower on autopilot, correct? Take the day-to-day struggle out of it.
Exactly. This strategy starts with a really critical piece of self-awareness. Recognizing that our innate desire for immediate gratification, for spending now, is often far stronger than our temporary willpower on any given Tuesday afternoon.
So true.
Automation helps us bypass that constant internal struggle by making good financial habits the default setting. It takes the active decision-making out of the moment, drastically reducing the chance for biases like impulsivity or procrastination to creep in and sabotage our intentions.
So what are some of the key actionable tactics for automation that listeners could potentially implement right away?
Okay, first and foremost, if you have access to a retirement plan through your employer, like a 401k or similar, automatically contribute as much as you possibly can, ideally aiming to max it out over the year.
Why is that so crucial?
Well, it provides 3 critical benefits, usually. 1, immediate tax deferral. Your contributions often reduce your taxable income now. 2, potentially significant employer matches, which is essentially free money. You should always try to get the full match.
Definitely don't leave free money on the table.
Never. And 3, it offers automatic investing into diversified funds, often through easy-to-manage index funds or target date funds that adjust risk over time. It just happens without you thinking about it each payday. And a smart sub-tactic here is potentially front-loading these contributions if your plan allows. That means contributing as much as possible early in the calendar year to get your money working for you sooner, maximizing that tax-free growth over time. More time in the market.
That makes sense. But it shouldn't stop with just employer-sponsored retirement plans, should it? Many people have savings goals beyond just retirement, buying a house, kids' education.
Absolutely not. If you've maxed out your tax-advantaged retirement accounts and still have savings capacity, the next step is setting up regular, automated transfers from your checking account directly into taxable brokerage accounts. This systematically builds wealth for multiple purposes beyond retirement, ensuring consistent investment without you having to actively remember to do it each month or fight the urge to spend that money instead.
Automate investing outside of retirement, too. Got it. What else?
Beyond investing, automate transfers to specific savings accounts for particular goals. Call one account a rainy day fund, another a new car fund, maybe a vacation fund. Giving that money a specific mental job actually helps discourage frivolous withdrawals. It leverages mental accounting for good.
Using a bias to fight a bias.
Exactly. And of course, automate all your essential bill payments, mortgage, utilities, credit cards to ensure you never miss a due date. This avoids late fees, protects your credit score, and reduces financial stress.
I really love the idea you mentioned of creating separate sub-accounts within a savings account for really specific goals like kids' holiday gifts or annual property tax payment. It seems like a great way to keep funds organized and prevent accidental overspending by clearly delineating what money is for what purpose.
It really is. It's a perfect example of a simple nudge that we'll discuss more later. It just makes managing those specific, predictable expenses much easier. And this naturally brings us to the other side of the coin. Discipline. Automation handles the mechanics, but discipline is the mindset.
How do you define discipline in this context?
Discipline here is really the ability to do what you need to do, even when you don't particularly want to do it. It's about establishing specific, non-negotiable times for reviewing your finances, whether that's monthly, quarterly, or annually, and then rigorously sticking to that schedule. Being consistent is paramount. Whether it's consistently maintaining that emergency fund buffer, regularly investing predetermined amounts into broad market funds like VOO or VTI, or simply tracking your spending to stay aware, consistency is the secret sauce.
And a simple, practical tip I saw mentioned that resonated with me was keeping a journal of your strategy decisions. Like, why did I buy that stock? Why did I choose this savings rate?
That's an excellent practice. It helps you track your rationale at the time you made the decision, free from hindsight bias. It provides a valuable learning tool to review outcomes later, understand your own decision patterns, identify recurring biases, and hopefully become a better, more self-aware investor over time.
Learn from your own history.
Exactly. And critically, simplicity is often key in all of this. Avoid unnecessary overcomplexity. Stick to traditional, transparent, low-cost investments like diversified stocks and bonds, often through index funds or ETFs. Try to resist chasing complicated alternative strategies or trendy investments that often require constant oversight, add hidden layers of fees, or introduce unnecessary risks that you might not fully understand. The goal is to make the good choices easy and automatic, not to create a complex financial machine that requires constant, stressful tweaking.
So the core insight here is that leveraging automation turns good financial intentions into consistent, almost effortless habits. It overrides our natural inclination for instant gratification and ensures our long-term goals are met more reliably, almost by default.
You got it. Set it and forget it, but review it periodically.
Okay, our third strategy to protect yourself from yourself is a two-parter. Embrace thoughtful diversification, and importantly, actively seek external perspective. It's about spreading your eggs, but doing it smartly, and sometimes acknowledging you might need help seeing the whole picture.
Indeed. And this goes well beyond that naive diversification we talked about, just randomly having a bunch of different stuff like the 1N rule.
Yeah.
True, thoughtful diversification means ensuring your assets are sensibly related, or perhaps more accurately, unrelated or negatively correlated. They should be designed to either complement each other or offset each other's movements to reduce overall portfolio volatility.
So it's not just about having many things, but having the right mix of things that behave differently.
Precisely. Mental accounting, as we discussed, often leads investors to overlook these true benefits of thoughtful diversification. They tend to view individual investments in isolation. How's my tech stock doing? How is my bond fund doing? Rather than seeing them as components of a cohesive, risk-mitigating portfolio, where the interaction between them is key.
And the impact on our emotional biases seems significant here. Diversification is absolutely essential for overcoming emotional biases, isn't it? Because it naturally reduces the impact of any single investment's performance on your overall wealth.
Exactly. If one stock you own takes a nosedive, but it's only 2% of your portfolio, it's much less likely to cause panic than if it represented 20% or 30%. It helps investors avoid that panic selling based on just one or two individual stock dips. It gives you that crucial emotional buffer to stick with your long-term plan.
This seems like an area where an external perspective, like a good financial advisor, could be really valuable.
It absolutely is. This is precisely where an unbiased financial advisor can be a huge asset. Studies have consistently shown that advisors can improve portfolio efficiency. For example, by recommending lower allocations to home country stocks, directly addressing that familiarity bias we discussed, and advocating for greater investment in foreign stocks and other asset classes to broaden diversification appropriately.
So they help you get out of your own familiar bubble.
Right. And research has actually shown that such recommended portfolios, designed with diversification principles in mind, tend to outperform the actual portfolios that investors construct on their own. It illustrates the tangible benefit of having an objective outside perspective that isn't clouded by the same biases. For those who manage their own money, a key aspect of critical thinking to cultivate is rigorously testing your own presuppositions. Constantly invert your investment arguments. Actively think about why you might be wrong to understand potential flaws in your own reasoning. In-depth, unbiased research, not just confirming your existing beliefs, is the cornerstone of a sound methodology.
What's truly fascinating here, though, and maybe a little frustrating, is that studies show even when free and unbiased financial advice has been offered, say, in an experiment where commissions on recommended products were waived, surprisingly few investors actually accept it. And those who do accept advice often show a strange preference for recommendations from, like, coworkers or friends over those from proven experts. Why is that?
It's a powerful illustration of our inherent biases at play again. Maybe it's a resistance to external authority. Maybe it's overconfidence in our own judgment. I know best. Maybe it's just easier to trust someone you know personally, even if they lack expertise. There seems to be a powerful psychological barrier to accepting good advice, even when it's clearly beneficial and offered freely.
We trust Dave from accounting more than the certified financial planner sometimes.
It often seems that way, unfortunately. And a practical reflection for listeners, especially younger ones, is this. While it might be tempting to really ramp up your risk exposure chasing higher returns, always balance this with sensible diversification. Don't put all your eggs in one basket, even if it feels exciting. But also, don't go overboard the other way. If you diversify too much, owning tiny slivers of everything, you may just end up matching the market return minus fees without adding any potential for outperformance or alpha. There's a sweet spot between being too concentrated and being overly diversified. And that's often where an external perspective can help you find your appropriate balance.
So the core insight here is that thoughtful diversification and the courage to seek objective, external advice are crucial defenses against our biases. They prevent emotional overreactions and help ensure our portfolio reflects true long-term strategy, not just our gut feelings or familiar preferences.
Exactly. It's about building a portfolio based on principles, not just emotions.
And finally, our fourth strategy, to protect yourself from yourself. Leverage nudges for better financial habits. This sounds like we're almost tricking our brains, but, for our own good.
Precisely. That's a great way to put it. Nudge theory, which was really popularized by behavioral economists Richard Thaler and Cass Sunstein, describes these subtle policy adjustments or design choices that gently encourage people to make decisions that improve their financial well-being. Crucially, without actually limiting their freedom of choice.
So it's not forcing anyone, just making the better choice easier.
Exactly. They're like gentle pushes in the right direction, making the better choice the easier one, the more obvious one, the default one.
Okay, so what are some really effective examples of these nudges in action that can make a tangible difference for our finances?
Defaults are incredibly powerful. Probably the most famous example is automatic enrollment in workplace pension plans or retirement savings plans, often combined with default investment funds. These mechanisms have been shown to significantly increase savings rates across the board simply because people are far less likely to take the active step to opt out of saving once they're already enrolled. It harnesses our natural human inertia, our tendency to stick with the default, for good. It turns procrastination into a benefit.
That's brilliant. Using laziness for good. What else?
Framing, which we discussed as a bias, can also be used as a powerful nudge. For instance, simply labeling a savings account as a rainy day fund or maybe a dream vacation fund can subtly discourage withdrawals for frivolous expenditures because that money now has a clear, emotionally resonant purpose attached to it.
It feels wrong to spend the rainy day money on a sunny day purchase.
Exactly. Similarly, framing loan information differently, maybe showing the total dollar cost over the life of the loan prominently versus just the relatively low-sounding annual percentage rate, APR, can powerfully reduce the likelihood of people taking out another loan because the true cumulative cost becomes much clearer and more salient. It's all about how the message is packaged to influence perception and behavior.
Rules of thumb can be nudges too.
Yes, they serve as excellent cognitive nudges. Simple, actionable rules for financial management, like the widely known 50-30-20 rule for budgeting.
50% needs, 30% wants, 20% savings debt.
Right. Or simpler rules like saving at least 3 months' salary for a short-term emergency buffer. These provide clear, easily digestible guidance that simplifies complex decisions. Emphasizing a straightforward principle like always know the real cost of the money you owe can be a powerful mental trigger, prompting more thoughtful borrowing decisions.
What about things like rewards or making it fun?
Absolutely. Rewards and gamification can be fantastic nudges. Setting sequential targets for savings or debt repayment, and providing positive reinforcement, maybe small non-monetary rewards, badges, or just tracking progress visually as those goals are reached, makes saving feel more like a game we want to win, rather than a tedious chore. It taps into our brain's natural reward systems.
And can we even use loss aversion, that powerful negative bias, for good?
We can try. Imagine, for example, a system that notifies consumers in real time of the extra charges or interest they incur by choosing to use credit instead of available savings to cover an unexpected cost. This could powerfully highlight the tangible, immediate benefit of having saved that money because it frames the cost of not saving as an explicit, immediate loss rather than just a vague future gain missed. It makes the pain of not saving more concrete.
That's clever. What about social influence? Does that work as a nudge?
It's incredibly powerful and often underestimated. Peer effects and aspirational effects, things like publicly announcing your savings goals to friends or family, creating accountability, having a savings buddy who checks in on your progress, or receiving updates on a group's collective savings progress, have been shown to significantly increase savings rates.
More than just offering more interest.
Yes. One fascinating study found these social effects were actually more impactful in boosting savings than offering substantially higher interest rates. It just goes to show that we really are social creatures at heart. And our desire for connection, belonging, and maybe a little bit of social comparison extends deeply into our financial habits.
That's amazing. So connecting savings to community works.
It seems to, very effectively. And this connects beautifully to the broader need for financial literacy and education initiatives as well. These programs are absolutely critical for individuals to understand financial products, grasp market mechanics, learn about these biases, and ultimately make informed choices. Targeted programs, especially for youth starting out and for underrepresented groups who may face systemic barriers, are vital to address existing knowledge gaps that can unfortunately lead to adverse financial outcomes and perpetuate cycles of disadvantage.
And underlying all these nudges and strategies, it seems like a fundamental step is just understanding your own emotional triggers.
Absolutely fundamental. The very first step in overcoming emotional biases is becoming deeply aware of your own emotions. What triggers fear for you? What triggers greed or FOMO? How do these feelings physically manifest? Being aware of your personal patterns and how they typically affect your decisions is crucial to prevent them from dictating your investments. And it's not just internal emotions. As we mentioned, research has even shown external influences like the weather, your general mood that day, even things like lunar cycles can subtly impact collective risk tolerance and market returns.
Seriously, the moon.
Studies suggest correlations, believe it or not. The point is, being aware of these external factors, even seemingly silly ones, also helps us recognize when our mood or judgment might be influenced by something completely unrelated to the investment itself. It allows us to pause, take a breath, and step back before making an impulsive decision driven by temporary feelings.
So the core insight here is that by strategically designing our financial environment and leveraging these clever nudges, we can proactively guide ourselves towards better financial habits. We make the smart choice, the easy choice, without ever feeling restricted or deprived.
Exactly. It's about working with our psychology, not constantly fighting against it.
Wow, we've really covered a lot of ground today, diving deep into the individual psychological battle that plays out in our financial lives, all those biases, all those strategies. But maybe let's zoom out for just a moment and look at the bigger picture. How do things like society, culture, and even our very biology play a role in our money decisions? It's not all just individual psychology in a vacuum, right?
No, it's absolutely crucial to understand this broader context because our individual decisions don't happen in isolation. They're shaped by the world around us. Globally, there's been this pervasive phenomenon that economists call the financialization of savings. What does that mean? Well, it represents a significant shift away from traditional, often simpler savings methods.
Like just putting cash under the mattress or in a basic savings account.
Exactly. Or maybe fixed deposits. A shift away from those towards far more technical and sophisticated financial instruments. Stocks, bonds, mutual funds, ETFs, maybe even derivatives for some. It's really a move from simple saving to much more active, complex investing becoming the norm, or at least the expectation.
And this huge shift, as the research points out, isn't just some natural organic evolution, is it? It's been driven by powerful forces.
That's right. It's been catalyzed by things like rapid technological advancements, think online brokerages, robo-advisors, instant market access, also extensive deregulation of financial services across many economies over the past few decades, and very importantly, an increasing societal and governmental emphasis on individual financial responsibility.
Like the shift from defined benefit pensions to defined contribution plans like 401k.
Precisely. Governments and institutions are increasingly pushing for citizens to take more ownership of their retirement planning and long-term financial security. But here's the rub, and it's a big one. This shift often requires a basic degree of financial literacy, comfort with volatility, and familiarity with complex instruments that is frequently lacking in the average citizen.
So society expects more, but hasn't necessarily equipped everyone.
That's the challenge. We see this starkly in a country like India, for example. Huge population, 144 crores, but estimates suggest only around 3.5 crore mutual fund folios, or accounts. That's a massive gap in engagement and understanding. It suggests a huge segment of the population is either opting out entirely, perhaps sticking to older savings methods, or maybe just isn't equipped or confident enough to participate fully in this increasingly financialized world. This creates both significant challenges and huge opportunities for widespread, accessible financial education.
Absolutely. And then we move into the really personal, almost primal realm of the physiology of investing, that classic nature versus nurture debate, but applied to our financial lives. Does our biology play a role?
It does, and it's a fascinating and expanding area of research. We now know that biology, including our genetics and even our brain structure and chemistry, neuroscience, plays a measurable role in our financial behavior. For example, twin studies, which are great for teasing out nature versus nurture because they compare identical twins who share 100% of their genes to fraternal twins who share about 50%.
Right.
These studies suggest that genetic factors can explain roughly 1/3 of the observed variation between individuals in their investor choices and their inherent levels of risk aversion.
1/3. So there is a biological predisposition, a kind of financial DNA.
It seems so.
Yeah.
It suggests there's a biological component that influences our financial comfort zones, our baseline willingness to take risks.
And this feels like the important, but it's not all predetermined, right? Which is incredibly good news for those of us looking to make behavioral changes.
Exactly. Contrast the twin studies with adoption studies. They provide a different lens, looking at adopted children compared to their biological and adoptive parents. These studies show that the environmental or post-birth affect essentially how you were raised, your family's attitudes towards money, your education, your personal experiences with gains and losses. This nurture component has roughly twice the impact on whether someone participates in the stock market at all, and a remarkable 4 times the impact on the level of risk they take in their investments, compared to the effect of genetics alone.
4 times the impact on risk level. Oh, wow.
Yeah. So while nature definitely plays a part, setting maybe a baseline, our environment and life experiences nurture often matter significantly more for the actual financial decisions we make day to day and the amount of risk we're comfortable taking with our money. It's a really fascinating interplay where nurture often strongly nudges nature.
And we also see intriguing gender differences reflected in some of this research.
We do. Women, for example, consistently across many studies and cultures, often exhibit more risk aversion than men. This shows up both in their actual investment portfolio allocations and in choices made during experimental financial gamble scenarios. This likely reflects a complex combination of factors, perhaps social learning, cultural gender stereotypes about risk-taking and financial roles, but potentially also some inherent biological or hormonal differences. The exact mix is still debated.
And specific genes are being linked too.
Yes, research is starting to identify specific genetic markers. For instance, variations in genes like the DRD4 alleles, which are related to how our brains process dopamine.
Dopamine, the reward chemical.
Exactly. Dopamine is associated with reward, motivation, and novelty seeking. Certain variations in these dopamine-related genes have been correlated with higher levels of financial risk-taking behavior, and in some cases, even predispositions towards things like compulsive gambling. This offers a tantalizing glimpse into how our individual brain chemistry might subtly influence our financial impulsivity and decision-making.
And finally, as we navigate the journey of life, there's the impact of cognitive aging. How does getting older affect our financial decisions?
That's another important factor. Research generally suggests that the increase in financial risk aversion that often comes with getting older isn't just about having less time to recover from losses, although that's part of it. A significant portion seems to be due to natural cognitive decline, maybe a subtly reduced ability to process complex information quickly or weigh uncertain outcomes effectively.
But there's good news here too.
Yes, there is. And this is the encouraging part for seasoned investors. The investment experience gained over many years, the practical wisdom accumulated through navigating multiple market cycles can actually offset some of these negative impacts of cognitive aging on decision-making quality.
So wisdom can compensate for slightly slower processing.
It appears so. So while our brains might naturally slow down a bit in some processing areas as we age, our accumulated wisdom, our hard-won practical lessons from decades of market booms and busts can still guide us very effectively. It's actually a powerful argument for starting your investing journey early, learning along the way, and building that experience base over time.
So what does this all mean for you, our listener, as you navigate your own financial life? We've taken a really deep dive today into this fascinating, sometimes confusing, intricate world where psychology meets your money. We've uncovered how these common yet incredibly powerful biases, things like overconfidence, anchoring, loss aversion, and the disposition effect, herding, representativeness and familiarity, mental accounting and framing can subtly, and sometimes not so subtly, steer your financial decisions, often away from your own best interests. It's certainly a lot to consider, isn't it?
It really is.
But understanding these forces, just bringing them into the light, truly is the first and most crucial step towards taking back control.
But the key takeaway, the really empowering truth we hope you leave with, is this. By understanding these biases, by acknowledging their ever-present influence, and then by actively, intentionally employing the powerful strategies we've discussed today, things like cultivating that long-term, goal-oriented mindset, embracing the power of automation and discipline, diversifying thoughtfully and having the humility to seek external perspective when needed, and intelligently leveraging those smart nudges to make good choices easier. By doing these things, you absolutely can build a portfolio and indeed a whole financial life that truly protects you from your own inherent human nature.
It's not about becoming a robot, is it? Devoid of emotion.
Not at all. It's about empowering yourself to make more informed, more rational choices that are genuinely aligned with your deepest, most important long-term financial goals, rather than just being driven by your fleeting impulses or fears of the moment.
And it's so reassuring, I think, to know that taking control of your personal finances is absolutely possible. It doesn't require complicated formulas that only a Wall Street quant could understand.
No, definitely not.
It happens through simple, consistent, and behaviorally aware steps. Small, deliberate actions repeated patiently over time can lead to truly massive long-term benefits and, perhaps just as importantly, profound peace of mind. We truly hope this deep dive leaves you with a sense of clarity, renewed motivation, and the certainty that financial psychology offers practical, accessible, and deeply personal solutions for absolutely everyone, no matter where you're starting from. What stands out to you from today's discussion? Was there a bias that particularly resonated or a strategy you're keen to try? We'd genuinely love to hear your thoughts. Share this deep dive with friends or family who might find it useful. Leave us a comment or review wherever you listen. It really helps others find the show. And please, join our community as we continue to explore this intricate, vital dance between our minds and our money.
And maybe consider this for a moment as a final thought to mull over. If social influence and peer pressure, as we saw, can significantly boost our savings rates, sometimes even more effectively than the traditional lure of higher interest rates, what other collective behavioral nudges could we, perhaps as a society, implement on a broader scale to profoundly foster greater financial well-being and resilience for everyone. It's a powerful thought, isn't it? What could we achieve together?
It really is. Food for thought. Until next time, be patient with yourself, be kind to yourself as you navigate this, and be incredibly intentional with your money. Thanks so much for joining us on the Dup Dive.